Buy in cash versus with a mortgage. So this is a question that depends on your individual circumstances and external factors. However, the general answer is to purchase with a mortgage. There are advantages and disadvantages to both avenues though, but let's go through it. So one of the big advantages of purchasing cash is that there can be opportunities to secure far better deals and lower prices as you are able to act quickly, which can be really, really attractive to sellers. The other advantage you can have with purchasing cash is you have no mortgage payments to pay for every month, and therefore you're simply getting more cash in your pocket. The biggest downside is purchasing in full cash is that you're simply putting all your cash into one property, and potentially it could limit your ability to purchase another. Well, this then leads on to purchasing with a mortgage. The big advantage to purchasing with a mortgage is that you can potentially leverage your cash across multiple properties and potentially earn returns off of the bank's money. So what I mean by this is, let's say you have 50,000 to invest, meaning you can secure a property up to the value of 200,000. The cost of the £150,000 loan is 5% per year. However, the property in fact is making you 8% per year plus capital appreciation. This means that whilst you're borrowing at 5%, you are making 8%. So effectively, you are gaining 3% on 150,000, which isn't even your money. You also can't forget that if the property is growing 5% a year, you're making 5% a year on the full 200,000, equating to £10,000 per year, when in fact, you've only put in 50,000 of your own cash. If you were to use this business model for every 50K you have, as opposed to purchasing one property in cash, then you are more than likely to make far more money over time. This method only becomes a negative factor if you are ever at a point where the cost of borrowing from the bank is more than what in fact you are earning. If this does become the case, then it does make sense to have the loan. Typically speaking, with the low rates we generally have faced over the years, most investors leverage with a mortgage, as it is a far quicker way to build up a portfolio and in fact spread your money across multiple properties and limits your risk.